Hello and welcome to Investment Insight. Before you begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Absolutely. And there is a lot to break down today.
There really is. We're looking at a situation right now that is just sending absolute shockwaves through the global economy.
Oh, for sure.
And if you've been watching the news at all, you already know the trigger. We're talking about the recent outbreak of the war involving Iran, coupled with this just terrifying threat of a total blockade at the Strait of Hormuz.
Which is basically the global economy's jugular vein.
Right, exactly. And it has sent global oil markets into a total frenzy. I mean, we are looking at Brent and WTI crude oil prices spiking by around 20%.
It was overnight.
Yeah, almost overnight. And on top of that, you have major production disruptions hitting places like Iraq and Kuwait. So it's the kind of geopolitical earthquake that makes every investor sit up and take notice.
Because when that specific waterway, the Strait of Hormuz, is threatened, sheer panic is just the natural, immediate market response. Millions of barrels pass through that narrow channel every single day.
Right.
And cutting that off, it just starves the market instantly.
Which brings us to the core mystery of today's deep dive. Because when you look across the board at Asian markets right now, there's widespread panic. Supply chains are scrambling, manufacturing hubs are bracing for the worst.
As you'd expect.
Right, as you'd expect. But then you look at China, which is the world's largest energy importer. Logically, the country that buys more foreign oil than anyone else on the planet should be panicking the most.
You would think so, yes.
But instead, they seem oddly calm. Why is the nation with the heaviest reliance on energy imports shaking off this massive global shock so much better than its neighbors?
Well, to be clear right up front, China is not completely immune to this crisis.
Sure.
I mean, no economy is fully insulated from a 20% spike in global crude prices. But according to recent analysis, they're relatively less vulnerable.
Relatively less vulnerable. Okay.
Yeah. And by the time we finish breaking down the data today, you'll understand how China's specific defense strategy for this crisis might actually make the situation significantly worse for the rest of the world.
That's a huge claim. Let's get into the mechanics of how they're surviving this initial shock, because it really comes down to preparation. For anyone listening who's new to this, I like to think of this using a neighborhood analogy.
Okay, let's hear it.
Imagine you live in a town where there's only one giant grocery store, and suddenly that store burns to the ground.
The supply chain is completely breaking.
Exactly. Most of your neighbors are going to completely panic because their refrigerators are empty. They live week to week on groceries. But China operates like that one neighbor who built a massive underground doomsday prepper bunker and just packed it to the ceiling with canned goods and bottled water.
That's a really good way to look at it. Because when we look at the hard data, China's bunker in this scenario is their strategic and commercial oil reserve.
And it's huge, right?
It's massive. Current estimates show they've built up a jaw-dropping stockpile of about 900 million barrels of oil.
900 million.
Yeah. And to put the sheer scale of that into perspective for you, 900 million barrels covers roughly 78 days' worth of their total national imports.
Wow. Over 2.5 months. That means they could theoretically cut off all foreign oil shipments for 78 days and still keep their cities lit and their factories running at baseline levels.
Essentially, yes.
But 78 days is still a finite window. I mean, if the Strait of Hormuz is blocked for 6 months, that bunker eventually runs dry.
It does. But the duration of the reserve is only one part of the strategy. The timing of how they built this stockpile is crucial.
When did they buy it all?
Based on recent analysis, they spent all of 2025 and the beginning of 2026 quietly hoarding this surplus crude.
Oh, wow.
Right. They were filling their pantry over an extended period when global prices were relatively stable. Because they had the foresight to build that cushion. They don't have to enter today's market and panic buy oil at these newly inflated wartime prices.
They can simply tap the reserve and wait out the initial price shock.
Exactly.
Okay, that provides a massive financial cushion. But they still need new supply flowing in to keep from depleting those reserves entirely. They can't rely solely on what they have stored away.
No, they can't. And the data reveals a very aggressive diversification strategy to address that exact problem. China still relies on the Middle East for about half of its oil. So a disruption there definitely creates friction.
Sure.
However, before this current conflict erupted, China had secured heavily discounted crude oil contracts from Russia and Iran.
I see.
They were capitalizing on alternative land-based pipelines and different maritime routes right up until the war started.
Okay, I want to pause right here and add a quick disclaimer. Just to be completely clear for everyone listening, we are looking strictly at the economic and market data today.
Right.
We're impartially reporting on the economic strategies laid out in the source material so you can understand what is moving your portfolio. We are not endorsing any geopolitical actions from any of the countries involved.
Completely agreed. From a purely mechanical and logistical standpoint, these alternative supply lines are vital.
Right.
Because China utilizes land-based pipelines from Russia, they are physically bypassing the contested maritime choke points. They just aren't as trapped by the Strait of Hormuz blockade as countries like Japan, South Korea, or India.
Because those countries rely almost entirely on ocean freighters passing through that specific waterway.
Exactly.
Okay, so it's a layered defense. They have the 900 million barrel reserve, and they've diversified their supply lines. Let's move to their next layer of defense, which involves a massive shift in their domestic infrastructure.
This is where it gets really interesting.
It really is. Think about what happens here in the United States when gas prices suddenly spike. If you drive a massive gas-guzzling truck, you feel that financial pain immediately at the pump.
Oh, yeah, every time.
Right. But if you own a hybrid car or a fully electric vehicle and the local gas station doubles its prices overnight, you shrug it off. You aren't just driving that hybrid to save the environment.
You're doing it to protect your wallet.
Exactly. You're doing it to protect your wallet from volatile gas prices. And China has essentially spent the last few years turning its entire national economy into that hybrid car.
That's spot on. Research into China's newest five-year plan outlines this transition in striking detail. Their stated policy goal is to hit 25% non-fossil energy consumption by the year 2030.
25%.
Yes. They're maintaining a baseline of domestic oil production at about 200 million tons a year just to keep things stable. But simultaneously, they're pumping unprecedented amounts of capital into electric vehicles, renewable energy infrastructure, and massive power grid upgrades.
Which really changes how we think about this. For years, the global conversation around green energy has been framed mostly through the lens of climate change and environmental policy.
Right, saving the planet.
Exactly. But what we are seeing play out right now shifts that narrative entirely. For China, green energy operates as a hardcore geopolitical and national security strategy.
Yes, it's defense.
They're building wind turbines, installing solar fields, and pushing electric vehicles to literally insulate their domestic economy from the exact type of Middle East chaos that's unfolding as we speak.
And connecting this shift to the broader economic picture completely changes how we evaluate energy investments. By electrifying their transit networks and relying more heavily on domestic solar and wind generation, every single barrel of oil they do not have to import from the Middle East represents a geopolitical vulnerability that has been erased.
It's a masterclass in macroeconomic risk mitigation.
It really is.
And the stock market demonstrated this reality perfectly on March 8th, the day investors really digested the severity of this war. The data from the Asian markets was brutal.
It was a bloodbath.
Total bloodbath. Japan's Nikkei index plummeted 7.5% in a single trading session. South Korea's KOSPI index dropped 8.1%.
Yeah, 8.1% in one day.
Just imagine checking your retirement portfolio over your morning coffee and seeing an 8% drop.
Terrifying.
But when you look at China's CSI 300 index for that same day, it only fell 2.3%.
And that gap tells you everything you need to know. A 2% drop reflects a cautious market. An 8% drop indicates structural panic.
Right.
The difference in those numbers highlights how global markets are actively pricing in China's massive buffer. Institutional investors looked at the industrial bases in Japan and Korea and recognized their total dependence on Middle Eastern oil to keep their factories running.
And then they looked at China.
Right. They looked at China's 900 million barrel reserve and their booming EV grid and priced in their ability to survive the disruption.
But that doesn't mean China gets through this completely unscathed, right? I mean, the doomsday prepper might have a bunker full of food, but eventually, if the crisis outside goes on long enough, the pressure starts to build. Does that armor hold up indefinitely?
Not indefinitely, no. The latest analysis from March 9th shows that China's resilience is conditional. We are already starting to see genuine cracks forming.
Okay, what kind of cracks?
Major Chinese oil refineries are actually beginning to reduce their operations. The data points specifically to a massive facility run by Zhejiang Petrochemical, which processes 200,000 barrels per day.
That's a huge facility.
Massive. And they have suddenly pushed forward their scheduled maintenance.
Pushed forward maintenance. During a massive global oil crisis, that seems like incredibly strategic timing. Why would a facility choose to turn off the machines and clean them right now instead of just announcing a production cut?
Because it functions as a stealthy production cut.
Ah,
Right. Instead of alarming the market by announcing they can't afford or acquire the crude oil they need due to Middle East supply chain friction, they use scheduled maintenance as a diplomatic cover to shut down operations.
it's a convenient excuse.
Exactly. It reveals that the supply chain friction is absolutely bleeding into their daily industrial operations despite the reserves.
So how is the government responding to that internal pressure? If their refineries are starting to slow down, they must be taking action to protect their domestic supply.
They are shifting into an extreme defense posture. Recent data confirms the Chinese government has ordered its domestic oil refineries to immediately halt any new fuel export contracts.
Halt them completely.
Completely. They've even taken the dramatic step of canceling shipments of fuel that were already scheduled and contracted to go to other countries.
Wow. So they are locking the bunker doors and hoarding the goods for themselves.
Yes.
It's a strict China-first strategy. They are strictly prioritizing their own citizens and their own economic stability, leaving the rest of the Asian market to fend for itself.
And this development raises a critical warning about global reliance on Chinese exports. They may be the most resilient country in Asia right now, but they have zero intention of acting as a safety net for neighboring economies. They're not going to drain their own reserves to supply the rest of the market.
Which leaves the rest of Asia completely exposed. And this actually leads us to a crucial economic concept for you to grasp today so you can understand the second wave of this crisis. Let's talk about the fundamental difference between crude oil and refined fuel.
All right, this is so important.
I call this the flour versus bread analogy. Crude oil is like a giant sack of raw flour. If you're starving, a sack of raw flour isn't going to help you much because you can't eat it as is.
No, you get sick.
Right. You need someone to take that flour, process it, and bake it into bread.
And in the global economy, this concept is known as the crack spread.
Yeah.
It's the difference between the price of raw crude and the petroleum products extracted from it.
The baked bread.
Right. Nobody runs their delivery trucks, their personal cars, or their cargo airplanes on raw crude oil. They require the refined products like gasoline, diesel, and jet fuel. Having millions of barrels of raw crude oil floating around the ocean on tankers does not help the economy function if the refineries that turn it into usable fuel are shutting down.
And we are seeing an incredibly dangerous disconnect in the pricing data right now based on that exact concept. Over in Singapore, which acts as the major trading hub and clearinghouse for Asian fuel markets, prices for the actual refined products, the jet fuel, the gasoline, the diesel, are skyrocketing at a much faster pace than the price of raw crude oil itself.
Yes, the widening crack spread in Singapore signals that the real immediate crisis isn't just a lack of raw oil pulling out of the ground in the Middle East. The acute crisis is a lack of the actual usable fuels that physically power the supply chain.
Because the refineries are offline.
Exactly. When a major player like China halts its refined fuel exports,
Yeah.
it removes a massive supply of that baked bread from the global market.
So what's the domino effect when China hoards its refined fuel? We've got countries like Australia, various Southeast Asian nations, and parts of South Asia that rely heavily on importing those specific refined fuels from Chinese facilities.
Well, those countries are suddenly starved of the fuel necessary to run their basic logistics.
Right.
Without diesel for their trucks or jet fuel for their cargo planes, their internal supply chains begin to seize up. They're forced to bid on a rapidly shrinking pool of available fuel, which drives the price up exponentially across the entire region.
Okay, let's bring this home for a second. Because as American investors navigating the current economy under President Trump, we are all hyper aware of how global supply chains impact the prices we pay at the local store.
Oh, absolutely. Inflation is top of mind.
Right. We saw how shipping bottlenecks caused massive inflation just a few years ago. How does a diesel and jet fuel shortage over in Asia physically hit the American consumer in the wallet?
It comes down to the physical movement of consumer goods across the Pacific.
Okay.
If there is a massive diesel shortage in Asian ports, the cost to operate the cargo ships and freight planes that carry manufactured goods to the United States will just explode.
And the shipping companies don't just eat that cost.
No, they pass those increased fuel costs directly onto the consumer. Global logistics, shipping, and freight costs will surge. That means the price of electronics, clothing, and everyday household goods on American store shelves will go up.
Wow.
Ironically, China's internal strength and their ability to hoard these resources is directly exposing and actively worsening the economic weakness of its neighbors and trade partners.
So the prepper locking themselves in the bunker is making the panic outside significantly worse.
Exactly.
So what does this all mean for you listening right now? How do you actually use this information to protect or grow your portfolio in this environment? Let's talk investor takeaways.
Let's do it.
If China is the strongest player on the board right now, should investors just be dumping all their capital into broad Chinese index funds?
You have to view China's position correctly in this specific context. China is not a guaranteed moneymaker or an offensive growth play during this crisis.
Oh.
Instead, they represent a defensive play within the Asian market. If this war in the Middle East drags on for several months, China's broader economy will likely just suffer fewer losses compared to the economies of Japan, South Korea, or India.
So it's a strategy of relative outperformance through damage control.
Right. Rather than explosive growth.
A lose-less strategy.
Yeah, exactly.
But if someone is looking to allocate capital strategically, where is the smart money actually moving inside China right now?
Well, looking at the data, the smart investment play inside China is not in their traditional oil refineries.
Because of the shutdowns.
Right. Those facilities are facing severe margin pressures, supply chain friction, and forced shutdowns, as we saw with Zhejiang Petrochemical. The real geopolitical hedge assets, the sectors benefiting from this massive push for national security, are the companies building the power grid, advancing battery storage technology, manufacturing renewable energy infrastructure, and expanding the electric vehicle supply chains.
That makes total sense.
The longer this oil shock lasts, the more capital the Chinese government will pour into those specific sectors to secure their energy independence.
They are essentially treating green tech companies as defense contractors.
That's a perfect way to phrase it.
That's a massive shift in perspective for anyone evaluating the energy sector. But let's flip to the other side of the coin. What are the warning signs? What specific sectors or regions should our listeners be actively evaluating or maybe even avoiding right now?
The biggest red flags are flying over the rest of the Asian market. Because of this severe, acute shortage in refined fuels, specifically diesel and jet fuel, you need to watch out for massive profit margin collapses in industries that physically burn a lot of fuel to operate.
Like what?
We're looking at the aviation sector, shipping and transportation logistics, heavy chemical production, and large-scale manufacturing in places like Japan, Korea, and India.
Because their operating costs are about to go through the roof.
Exactly.
And unlike China, they don't have a 900 million barrel cushion to fall back on or the domestic resources to absorb the blow.
They're completely exposed.
So if you hold heavy manufacturing or Asian logistics in your portfolio, it's time to take a very close look at their fuel dependency and how they plan to navigate a prolonged refined fuel shortage.
The downstream effects of a refined product shortage are brutal. They move through the supply chain incredibly fast, and profit margins in those fuel-heavy sectors will be compressed almost immediately.
This has been an incredibly eye-opening breakdown of how a geopolitical conflict halfway across the world reshapes the entire global economy.
It really is all connected.
It is. As we wrap up today's deep dive, I want to leave you with a final provocative thought to mull over. We are watching in real time as green energy, domestic power grids, and electric vehicles prove to be the ultimate shields against global war and catastrophic oil shocks. If we are seeing this play out right now, how will this current crisis secretly accelerate the entire world's transition to renewable energy? Not to save the planet or to meet climate goals, but for pure, ruthless economic survival. When the dust finally settles on this conflict, the new definition of national security might just be a solar panel and a high-capacity battery pack. Don't forget to subscribe and hit that like button.